How's it going, everyone? Welcome to the sweep. And we're going to get started here just in about 10 seconds. As you guys get logged in, feel free to chat in any questions you might have with regard to day trading. And we'll get to them at some point within the session. All right, let's go ahead and get going. So as always, like, share, and follow on social media, facebook.com/daytradesmart, instagram.com/daytradesmart, and the number 1, so daytradesmart1, youtube.com/the proving ground. And if you have any questions after that, you can always email us, info@daytradesmart.com. Obviously, if it's not obvious already, our website is daytradesmart.com. All right, so today what we're going to talk about is pacing ourselves. And before we do that, we're going to look at our trade of the week. So we're going to look at dirty pressure. And so let me set this up for you guys here. Dirty pressure involves a few of our indicators. It'll be the major and minor, which are those middle indicators that you'll see here in a moment. These right here, this green, red, gray, and black lines. And then the pressure indicator. So major, minor, and pressure indicator. It involves those two. And what we want to see is when the green line in pressure crosses on top of the red line in pressure, we want all 4 of these lines to be pointed up on the same candle. So in other words, if green crosses on top here, but these are not pointed up until the next candle or candles thereafter, that wouldn't count. We want them all to happen on the same candle, green cross on top, and these lines, major, minor, already being pointed up. And then we would take a long trade at the end of that candle, right, at the post. Here, we'd want to see the opposite. We would want to see green pop on bottom, cross on bottom of red, and then all 4 of these lines be pointed down when green crosses on bottom. And then it remains that way, and then on the new candle, we would take, at the beginning of the new candle, we'd take a sell trade. And today we'll use the same parameters that we've been using in other sessions. We'll just use a standard 2-to-1 ratio. So let's go back, and I got a good starting point here that kind of illustrates this for us. So I'm going to go back to that starting point. All right. So what I'm going to do is I'm going to set this up, and I'll kind of explain to you guys what we're looking at here in a moment. Let me pull up. Oh, I guess I don't have it. Okay, I'm going to build it real quick. I thought this was it, but it's not. All right, so what I'm going to do with this chart right here is I'm just going to remove everything except for the pressure indicator. And this is going to be linked with the chart here on the left. So what we're going to be looking at is all indicators on this chart right here and only pressure indicator on this chart. And the reason why I'm doing that is because I'm going to stretch this out. So I'm going to make it really large. Whoops, didn't want to do that. There we go. Make it really large so that we can very clearly see what the pressure lines are doing when they cross. Because you can see that in some of these examples. Now notice if I go back on one of these charts, on the chart over here to the left, this one also shifts backward. So if I go back to, say, here, it's very difficult sometimes to tell that that green line popped on bottom. Now, when we see that and we're not certain, we can just stretch it out and then put it back to where it was. In this case, my pixel value on the lower right hand is 37. You see this one down here is 236. So this is much larger, right? This is at 37 as a standard for me. So when we're trading, we're validating that setup. That's essentially what we do is we just stretch it out. There's no need to have 2 charts. But for the sake of this exercise, I'll have both charts present so we don't have to stretch it out. Now you'll notice that here it's very difficult to tell that green has crossed on bottom without stretching it out, where here it's obvious, right, because it's stretched out already. So that's why that's why we're looking at both of these charts. Now we're looking at the euro versus US dollar 60-minute chart. And let's just go for a 10 pip stop loss and a 5 pip take profit, which would be a 2-to-1 risk to reward ratio. Now, of course, in order for that ratio to work, we'd have to be hitting this trade 70% of the time or better. And so I'm not purporting that. I'm not saying that's the case. I don't know when you would trade this, what time you would trade it, what currency pair you'd trade it on. But we're just using it as an example today, just so we have a target, just like this is what we usually do, right? Okay. So first thing, I'm going to click forward and wait until I see that green line. Now that it's on bottom, I'll cross on top of the red line. And it's really close there, but it's still on bottom. We can see here. Right there, it crosses on top, right? And we know that, and we can see it much clearer here, right? And we know it just arrived there because on the previous candle, we can see that it's on bottom right there. And now on the current candle, it's on top. So that's our first trigger. And then the next thing we want to look for is, are these lines pointed up, right? Now, if you guys have attended any of our other sessions, especially on hiccup, head fake, or any kind of fake out when we get this double confirmation, that generally is the time where we want to start looking for a short trade. But we know 60 to 70% of the time we can still get some long movement out of that, right? So let's disregard that for a moment because we do have our pattern here, right? So this is dirty pressure setup. We've got green on top. It just arrived there on this candle, and all 4 lines are pointed up. So our entry would be here at 1.20720, right, when this candle ends and the new candle starts. And our take profit would be 1.20770, which would just be 5 pips up. 1.20770. And we'll make that line blue. And then our stop loss would be 1.20620. So right about, pretty close. 1.20620. Oops. And we'll make that line red. So there's our 2-to-1, right? Now, on the next candles, we want to see it, the market hit that blue line before it hits that red line. It looks like it did both, right? It kind of went up a little bit and down. It went up about 9.3 pips, went down 10.7. So which one went first, right? Did it go up or down first? Because if it went up first, then we know we won the trade. If it went down first and touched that red line, then we lost the trade, even if it went up after that, right? That's how it works. Okay, so right here we have a 5-minute chart just like we've done in the past. And on this 5-minute chart, we can see that this is the last 5 minutes of this 60-minute candle. So let's look at the first 5, 10, 15 minutes to see, did it go up first for 5 pips before it went down for 10 pips. So I'm going to click forward here. And that went up 6 pips. Yeah, so that was enough, right? We know altogether it went up about 9.3, but 6 is enough to cover even spread. It went down 4.5. So within that 5 minutes, it may have even gone down first, but it didn't go down 10 before it went up by 5 or more. And so in this case, it went up by 6. So that would have gone up 6 pips and then came down, and then whatever else it would have done after that. So good. All right. Now on this very next candle, we can see that we hit our dirty pressure setup again, right? So if I go back, we can see that on this candle, which is why we took that trade, green is on top, all 4 lines are pointed up, right? And then on this next candle, green is now on bottom, and it's not as clear there, it's as clear here. We can see green is on bottom there, right? And now all 4 lines are pointed down. So we've got all the elements that we need for our dirty pressure setup. Let me try to stretch that out a little bit. Okay, good. Okay. All right, so right here we would take our short or sell trade at the end of that candle, which would be 1.20696. Our take profit would then be 1.20646. And our stop loss, 646. And our stop loss would be 1.20796. 796. And that'll be our stop loss. So again, here we just want to see it come down to that red line before it goes up to, or sorry, come down to the blue line before it goes up to the red line in the next candles, right? Let's go forward. Good. That would have worked out just fine. That moved, whoops, about 10.4 pips, so double what we needed for profit, and it only moved up about 1.1 pips. So a much cleaner trade for that first candle, and we're good. All right, so let's continue forward. Let's look for our next setup here. So now that green is on bottom, we're waiting for it to pop on top of red. So it's still on bottom. Okay, good, right there. Pops on top of red. All four lines are pointed up. So right there is where we would execute our buy trade. And our entry would be 1.20538, so 1.20588 would be our take profit. And our stop loss would be 1.20438. So this is our blue line, take profit line. Our red line would be 438. 1.20438. Nope. There we go. 1.20438. Good. And that will be our red line. So again, here we just want to hit that blue line before we hit that red line. Click forward. Good. That one would have been just fine as well. 6.8 pips up for that first candle, only 2.1 drawdown, so that would have been another clean take profit as well. All right, so let's look for our next one here. Now again, we're looking at just the pressure indicator first. Then when we get our indication there, then we can look to see if we have our validating indication with major and minor. So click forward. Got some narrowing there. Okay, right there, right? Right there we've got green on bottom. It just crossed on bottom of red. And all four of these lines are pointed down. So right there we would take a sell or a short trade. So let's replay this just so we're clear as to when we would execute this trade, right? When we would jump into this trade. So replay, and we're going to replay that chart. Let's wait for that to load. So at the very start of this candle, we actually had the dirty pressure setup, right? Green is on bottom. All four lines are pointed down. But this candle has not ended. We still have 59 minutes and 50 seconds, or 30 seconds. So we may not have even been looking at that point, right? Because if we know that we're going to execute at the top of the hour when the candle ends, then we're not even reviewing as to whether or not we're going to enter this trade until this gets to maybe 5-10 minutes before the top of the hour. Right, so we're not just sitting around watching paint dry. So let's fast forward this. Let's go 500 times the speed. So 30 minutes, 20 minutes. So 7 minutes. I want to slow this down because, again, I want to show you what happens right about at the 5-minute mark. So right about there, right? 5 minutes to the top of the hour. All of our parameters are present. That will automatically trigger an alert. So the alert comes out and it'll say, you know, like this, Euro USD dirty pressure, right? And dirty pressure is actually one that happens really often. So today's a Friday, and Friday is usually a light day. But let's just count these out real quick. So let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. 14 times today we sent out notification for dirty pressure on 6 different currency pairs. So that's definitely enough, indication in there, enough opportunities in there to knock down even just a couple of them, right? And we know as day traders, if we took just a few trades a day, two trades a day, that could really set us up to, achieve our goals, our financial goals in a very small amount of time. Relatively speaking, it's not going to take 5 years, right? It could take a year, it could take 8 months, whatever it might be, right? And it depends. It's based on the individual because everyone's got different goals, right? Okay, so let's continue. So we've received our alert, right? And at this point, we see that we have 5 minutes left about. All of our parameters are there, so we're just going to wait the duration of that 5 minutes. So let's just speed this up just a little bit more. 42 seconds. So with 42 seconds, at that point, maybe we have our finger on the trigger, right? Getting ready to press that sell button. 20, 18, 16 seconds. So 16 seconds left, we are ready to go, right? Lock, stock, and barrel, ready to go. We know we put our lot size in based on our back testing. We know what our stop loss and our take profit are going to be. We're set to go. All we're waiting for is 16 seconds to press that sell button. So all of our parameters are there. Green's on bottom. All 4 lines are pointed down. For some reason we need to validate that. Obviously, we can just go back 1 candle. Green was on top on the previous candle. Now green's on bottom, and we're good to go. So I'm just going to draw a line here where we would have otherwise entered in our brokerage account, right? So 3 seconds, 2, 1, go. Right there. Boom. Oh, let me put that right where it needs to be, right there. Okay. So right there, we're in the trade, 1.20592, and we're looking for a sell. Now notice that as soon as that new candle came out, which is right there, you can't see because I have a line drawn right there, that minors are pointed up now, right? And the parameters where we want green on bottom, all 4 lines pointed down. But we're not looking at how this new candle is forming. We're looking at how the previous candle posted, how it formed and ended. So that's where we get our indication, right? It's telling us what's going to happen, not what's already happening. So right there, we've entered 1.20592. Our exit would be 1.20542. Oh, right there, right on it. Awesome. And our stop loss will be 1.20692. And now let's go ahead and play that out. And we'll fast forward. A little bit of oscillation, a little bit of up. It's coming back down. Moved up about 4.2 pips. See if it goes any higher than that before taking. No, it looks like we're going to clear profit before that. There we go. All right, good. So that moved into profit for us. It did draw down initially, 4.2 pips, and then it came back, and to that point is 14.7, which is almost triple what we were asking for, right? Which makes it a really safe trade in that regard. Let me fast forward this, get more candles here. Okay, let's look for a few more setups here. All right, so green's on bottom now. So now we're waiting for it to cross on top of red. So good, right here, green crosses on top of red, right? And when green's on top, we want all 4 of these lines pointed up. But right now they're pointed down. So this would not be our setup, right? Now, to be clear, we're looking for a square peg, square hole scenario. We're not looking, for anything discretionary. Either it fits the profile or it does not. And in this case, it does not. Now, just glancing at the charts, after a while, our traders get proficient enough with these indicators that this would be a good sell opportunity, right? We got thick orange, thin orange, blue dotted. Thick blue is against, but that's all right. Major, minor pivoted in the channel, pointed down. Pressure overall down. Green is on top. But this would be a good opportunity to take a short trade. Now, we're not looking at any of those other things. All we're looking at right now is our square peg, square hole. When green is on top, we want all 4 lines pointed up. Is it present? No. So we do nothing. Now, when green's on bottom, we want all 4 lines pointed down. If that was present, then yes, we would take a sell. But we don't have either of those scenarios here for our dirty pressure setup, so we do nothing on that. Even though the green crossed, it didn't have the other parameters, so we leave it alone. So let's continue. Now again, green has already crossed on top. So even if these lines start to point up later and green is still on top, it would not be like this. It would not be our setup, right? Because we want it to happen simultaneously. Green on top, all 4 lines pointed up on that candle, right? So we don't want them to be staggered. Okay, so let's continue. Green's on bottom, and when green's on bottom, we want all 4 of these lines pointed down. We only have 2 of them pointed down. Majors are down, minors are up. So again, we don't have our square peg, square hole scenario. We don't have the parameters that we're looking for, so we do nothing there. Now, green is on bottom here, and all 4 lines are pointed down, but again, it didn't cross. Green didn't just arrive on bottom on this candle. It just arrived on bottom on that candle. So therefore, this is, again, not our setup. We would not be executing right there for this particular pattern. Right here, green is on top, and all 4 lines are pointed up. So right here, we would take our buy or long trade. Now, when we look at pressure indicator, and I've mentioned this before, but I'll mention it again, our indicators work different ways. They work reactively or logically. So sometimes logically, if they're pointed up, then we're going to buy. And other times, they work illogically. Sometimes if they're pointed up, we're going to sell, right? Like the case of head fake, for example. Right? And if you guys haven't seen that one yet, you can go back and watch the videos on head fake. But it's illogical, right? Because initially and at a glance, it doesn't really make sense. But when we learn to understand what the indicators are telling us, we speak its language, then it becomes really clear. And then we can start using it much more discretionarily. But just like anything else, you got to learn the language first. And so we have building blocks in order to learn the language. Pattern trading is the third way that our indicators work, which is what we're going over today, which is a building block to learning how they work more discretionarily, right? And not having to wait for a pattern or a very systematic way of looking at the indicators. So in this case, this is very systematic, but also the thing I wanted to point out is that in pressure is not, what's most valuable about pressure is not the direction it's pointed. That is valuable, but it's not the most valuable. The most valuable is the narrowing and which color is on top and when it arrived there, and so on and so forth. So there's a lot there that takes experience to understand and really be able to utilize. But at some point, our traders get to a point where they're taking the trade as things narrow, as the indication narrows, versus when the actual cross actually occurs. And a lot of that is a result of staring at it a lot, having experience with it, and with just like with any art or craft, you want to continue to practice and study it so that you become much more proficient with it, right? And as a result, much more profitable, right? And some people will opt to do that with an organization. They'll opt to continue to learn how these nuances work so they can trade much more discretionarily, because ultimately what it does is it opens you up to being able to trade anytime you want, not waiting for a setup, but just being able to look at the indicators, reading what they're saying, and executing with a high level of proficiency, right? Versus having to wait for a setup. You're just able to read it like a book. Now, Others just choose to use the square peg, square hole scenario, where it's like, okay, I want these specific parameters. I get alerts for them. I can just sit around, do nothing, and wait for that alert to come out. I could be on the beach. I could be in the grocery store. I could be watching television. I could even be at work, whatever, whatever it may be, whatever, juncture you are in your day trading career. Maybe you're just still building an account, so you're still working another job. You haven't been able to supplement or replace your income yet. Right, so you've got a job, but you are able to step away when you need to, or take a moment, take 3 to 5 minutes to look at an indication and place a trade, right? And if that's what it is for you, and that's what you want, it works very effectively, right? Really, really well. And others want to just continue to challenge themselves and learn more and more about the indicators so that they can increase their up game. All it does is make you more and more profitable. So there's plenty of room to grow. All right, so right here. And we'll use this as our last example. 1.20226 would be our entry. So our take profit would be 1.20276. And that's going to be about 276. That's going to be our blue line. And our red line, our stop loss would be 1.20126. 126, and that'll be our red line, our stop loss. All right, let's click forward. Yep, easy peasy, nothing but net. It only went up. Looks like it went, no, it went down about 2.7 pips, and then up 12.1 pips. So almost triple what we were looking for take profit. Now the reason I want to point that out is because that's the value in back testing. When you go back, then you'll see, am I taking too little bit? Because that you're leaving money on the table, right? Or am I trying to take too much? Is my stop loss too far away, or is it too close? Right? Finding that sweet spot. That's why we have the golden ratio, which you guys aren't aware of yet. Some of you guys don't know how to use the golden ratio in order to figure out what that sweet spot is. What is going to be the most profitable for that setup, for the times that you trade the currency pair that you traded on, all that stuff. So, but there are ways that we've shown you, and you can watch those videos on how to backtest and get an answer, and maybe it's a general answer that works, which is great because it works. Money's money, profit's profit, right? But if there's something that could be more profitable, more lucrative, you definitely want to do that, right? Okay. Good. So that's our setup for the week, and that's dirty pressure. And I want to talk about pacing ourselves, right? Because a lot of times what happens is with new traders is that we get a trade set up, we back test it. Maybe we're only available for a couple of hours, right? Maybe you're only available from 7 p.m. to 9 p.m., before you go to sleep in the evenings. And you realize that you don't have a large frequency of trades, right? Maybe you're only taking one trade every other day, and you want to be able to create something that you're getting at least a trade a day, at least one trade a day to start, right? Start building that account in the right direction. So you've got one trade that's every other day, and so then you go and back test another setup or even the same setup on a different currency pair. And now you've got two trade opportunities, right? So you're still looking, for example, dirty pressure on the Euro USD, but you've now backtested dirty pressure on the USD JPY. And so now you have two opportunities in that same 2-hour block, 7 p.m. to 9 p.m., that you can take these trades. And maybe sometimes you'll get two trades in the same hour, or one trade in 1 hour and another trade in another hour, or just one trade out of the two, for the day. But it increases the availability of trades. Now, this sounds great, right? Because then you'd be taking more trades. Your account is going to build up much faster. But I want to caution you guys about pacing yourself. And sometimes it may not be just two trades. Two trades might be just fine in terms of pacing yourself. But I want to kind of point some things out that you need to be aware of, because you don't want to fall victim to the psychological facets of adding too many trades can cause, right? So let's kind of break this down a little bit. So once you've backtested your first setup and established win percentage, risk to reward, risk percentage, naturally you want to backtest some more. Doing so will increase your chances of seeing more trades throughout the day. The trap where we might find ourselves is attempting to implement multiple setups too soon. Now, I want to be clear about setups. When we say setups, we just mean it could be the same setup, the same pattern, but it's different in that you may be taking it on a different currency pair or a different time of day, those types of things. That makes it a different setup, right? So everything that goes into your setup is not only what it looks like, but what the parameters for which you'll be trading it are, right? So Euro USD, 7 p.m. to 9 p.m., win percentage is 70%, risk to reward of 2 to 1, risk percentage of 1%, right? So that's your first trade setup. That's the full setup, right? The second one could still be dirty pressure, could still be Euro USD, but maybe it's 6 a.m. to 8 a.m., right, which makes it a different setup. Your win percentage may be different, your risk to reward may be different, your risk percentage may be different. So it's a whole different setup, right? Same pattern, same currency pair, or same pattern, different currency pair, whatever it may be, it's a different setup. And so because of that, you're going to want to stagger when you bring in these new setups. And again, sometimes 2 might be just fine. But when you start talking about 3, 4, 5, it can get sticky, and I'll show you why here in a moment. So let's say we have a setup with the following parameters, right? 70% win rate, 2 to 1 risk to reward, risk percentage of 1%. Then we decide to add another, and this one has a win percent of 80, same risk to reward, 2 to 1, which makes it obviously more profitable, and we're able to jack up our risk percentage significantly because not only are we 10% bigger on our win percentage, but our risk to reward is really small as compared to 10% less, right? So we can risk 3%, right? Okay, so this is kind of how it breaks down. So we took some data from some other back testing and kind of showed the sequence of winner, loser, so on and so forth, and how this would play out. So first 10 trades, right? So these are 5 trades for this one, 70% 2 to 1. And again, let's just say that it's every other day. You're able to take this trade every other day. And so between the 2, you're able to take an average of 1 trade per day. Right? So maybe one day you get one here, one day you get one here, another day you get no setups in either, but then the following day you get 2 setups, right? So it works out to be about 1 trade a day for the week, right? And let's just say that it's each of these trades are going to be 1 day, even though realistically you saw we had 15, opportunities, so you could realistically get 2 trades in and some within 1 day on a regular basis. But let's just use the example of 1 trade per day. So if I have 5 trades here, then I have 0 trades in the other. But we're going to commingle them, right? We're going to say, okay, they ran back to back. So Monday I got a trade on the 70%. Tuesday I got a trade on the 80%. Just to kind of show you the example, okay? So our first trade was a winner. Our second trade was a loss. Our second trade was a loss. So that winner, if we're doing 1% risk, would be worth 0.5%, right? Because we're risking 1%, which is the 2, and our reward is 1. So half of 2, right? Which, if we're doing 1% risk, then it would be a 0.5% reward. Okay, so $50. Now our balance is $10,050, and then our next trade is a loss, and that's based on $10,050. So we lose 1% on this 70% trade, right? So that's $101. And then our next trade is a winner, and so we round that up and we get about $50, which is again 0.5% of our balance. And then the next trade is a winner, and we get $50.25. And then the fifth trade is a winner, and we get $50.50. And so altogether, our account balance is $10,100 after 5 days. Okay. Now we have our other trade, which is 80% win, and it just so happens to fall out this way. We win one. Now that winner, because we're risking 3%, half of that is going to be 1.5%. So that's how we get to 150, right? And then, and I'll show you how these numbers right here play in a moment. And then our next one is a loser, and that's based on 10,150. So 3% of that is 304.50, and we lose that. And then we get another loser, and that equals 295.50, which is 3% of 98.45.50. So our new balance is 95.50, right, which is about $450 down. And then the next one is a winner, so we dig out a little bit, right? We're at 9,693.25. And the next one is a winner, so 145.50, which is 1.5%. And so now we're at 9,838.75. Okay, so we're down, right, on our account balance. So if we commingle these, if we said, okay, winner, loser, right, then it would look like this. So we have one winner, loser, 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 winner, 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 winner. And our account balance at the end of that would be $9,939, right? Which would mean that we're down, you know, what is that, 79, or let's see, that's 40, so $59 or so, or $61. So we're down $61 after 10 days, and you know, our account balance starting at 10,000, right? So it says 10,050 because that's showing the $50 growth, right? So if we go back here, you can see that it started at 10,000, and that first trade was 10,050, right? Okay. So right here, that's how it would have played out, right? So what's the big deal, right? Because if at the end of the sequence, so let me show you the whole sequence here. At the end of that sequence, we have, so here's the first 10 trades, right? And that's why we were down 9,939, right? Okay, and then we take another trade, we win, another trade. Now we're up above capital. Capital is where we started, which is $10,000, right? So we're above capital right there. And then we take a loser, we're still above capital. Take another winner. Now the blue ones are the ones that are at 3% risk, and the yellow ones are the one at 1% risk. So now we're above capital again. Here we take a winner above capital, winner, and then we hit two losers. So that drops us below capital, right? And it isn't until the 19th day or the 19th trade that we get into profit, and we remain above capital, even with that loser, right? All the way down here, we have two losers back to back. That's still, we've built up enough in our streaks of winners here so that we have, we lost 340.50, right? But we're still $1,012 above capital, and then we lost another 110. We're still, you know, $902 above capital, and then back to, you know, 1,066 above capital, down to 955, so on and so forth, and then we end that 40 days, the 40 trades that would have taken each of those, up $1,342. Okay, so it took us 18 trades to get, or 19 trades to get above capital and remain above capital, right? Even though one of these is performing at 80% and the other one performing at 70%, right? So this is just with two trades. Now, if we thin that out even more and we get to a point where we're trading 4 or 5 setups simultaneously, it may take a while for those win percentages to even out, right? It's not gonna, you're not gonna get, you know, a 70. You could, right? But you could either get at less or more than what you've back tested in the first 10 trades. So you could be at your 70% win rate or 80% win rate after taking 10 trades on that one setup. Or you could be less than that, right? You could be 60%. Or you could be more than that. You could be 80%, right? So what we found is that 20 trades, right about 20 trades, that gives you a good, it gives the trade the ability to even out, right? To find its real, its true win percentage. right? So it's not going to happen. It could, but it's not likely to happen the first 10 trades. It's probably going to take like 20 trades in order for it to even out, right? The first 10 trades could be better, equal, or less, right? But after 20 trades, you start to normalize, right? Now, if we're adding too many, so if we had, let's say, 40 trades here, that's 20 trades in each of those setups, right? So it's 20 trades each, which equals 40. Now, if it takes, 20 trades to equal out, but you've got 5, 6 different setups that you're taking, you think about that. 6 times 20, right? That's 120 trades before they're, and that's if at that point they've all equally had their share of that 120 trades, right? So let me give you an example here so we can be really clear. So we provide backtest data for our members, and I'm going to pull up some of this backtest data. So let's go proving ground, let's go backtesting, and let's go to, okay. So let's say you're using this backtest data, right? So it basically says at this time for a buy, you could take this profit, this stop loss, and it's been backtested to win 78% of the time. And then the next hour, it's this and this for 82% of the time. If it's a sell at the same hour, it's different, right? 89% of the time, so on and so forth and so on, right? Now, if you're just taking just the euro versus US dollar on, let's just say, these first 4 hours right here, 1, 2, 3, 4 hours, that's 8 setups, because each of them have different parameters. That's 8 setups, okay? So if we're taking 8 setups and we need to have 20 trades in each of those hours for buy and each of those hours for sell, we're looking at 160 days or 160 trades, right? So 160 trades minimum, because what if you get more here than you get here or here, any of the other ones, right? So out of that 160, this accounts for 25% of them. Well, that means that, yeah, you've got your win percentage equaled out for this trade and this hour, but this one hasn't reached 20 yet, or this one hasn't reached 20, or whatever, whichever ones haven't reached 20 yet are not at theirs yet, right? And a lot of times, if you run into streaks where you've just got losing streaks across the board, right? Like here, that was 2 losing streaks for one of these, but turned into 3 losing streaks. That can really compound, right? And if you've got too many of them, you could, be in danger of drawing your account down significantly. It won't get to the point. It's not likely to get to the point, unless you're just trying to trade everything in sight, that you're burning your account and not giving your trades the opportunity to recover first, right? So 2 trades may not be a big issue, but you can see how 3, 4, 5, that could really be a big issue in not allowing your trades to hit their stride, what they're going to be on a regular basis, and then adding additional trades thereafter, right? But the biggest facet to this is that the psychological facet that the psychological facet that it has on you is much more detrimental, because being below capitals causes for you to second guess your approach. And when you start second guessing, those thoughts, those emotional thoughts start to come in, and you start to think to yourself, well, maybe I should add something to this or subtract something from this, or maybe I should try to switch something up. You try to change your plan without testing it, without actually getting any viable reason as to why you're gonna change your plan. You just decided to go, half-heartedly and change it because you're emotional, right? And the result of that is that you'll get to a place where you look back and you don't even know how you got to where you currently are. All you know that is you've lost a whole bunch of money and you're still uncertain as to how to properly trade. Even though you had it in the beginning, right, but you deviated from it. And those small deviations cause bad habits. And those bad habits cumulatively result in bad trading form. And it results in loss. And, when you get to that point, you can't even remember how you got there anymore, right? Which is why I always recommend that you journal, because you'll start to see those slight turns in the wrong direction. And we've had coaching sessions with individuals that have gone through this type of stuff. And when we go back and we look at that turning point, what happened was those deviations. They happen really often. We can see those deviations. And we propose the question, okay, if this is your trade setup, you can see that to this point you were following your trade setup. And then here you changed something. And then later on it changed more and more gradually to now being something that doesn't even resemble what you first started with, right? You overcomplicated it, or you added additional stuff, or you heard from the grapevine that something was going to work really well and you really tested it, you just kind of went with it, and it's not working, right? And we can go back to that point and we can say, okay, what would have happened if you would have stuck to your trade plan and continued to this point? And 9 out of 10 times it would have worked out profitably. It would have been profitable to that point, right? In the times where it's not, the exception where it's not that way, and it wouldn't have worked out, is because there was something else awry, right? Maybe it was the way they back tested or whatever it may be. There was something else that was out of place. And so, but with that being the exception, vast majority of the time, we can go back and say, okay, had we stuck to this trade plan, how would that have worked out? And we can see that it would have worked out profitably. They would have been much further ahead in their progress. They would have had above capital and on the right path. So deviating not only sets you back, but then it creates these bad habits. But mostly it creates this fear, right? And that fear is what takes over and causes for us to call those audibles, do things that we shouldn't be doing, changing the trade strategy before testing it. All that stuff is detrimental to your profitability in day trading. And so to the best of your ability, you want to be aware of those things. You also want to make sure that you've got your default setting, right? When you become emotional, okay, this is my trade plan. I'm starting to think, opposite, contrary-wise. I'm going to continue with it until I know I've got, at least 20 trades. And so let me break this down. Let me show you guys. So we'll get to the next slide here in a moment. It's not guaranteed that this will be the result of adding too many trade setups too soon, right? We've talked about that. This is just an example of how that could have worked out. But for the sake of psychology, or of your psychological well-being, it's not recommended that you take unnecessary chances. So this is an example including only 2 setups, right? So we talked about that as well. So what is recommended? And what is recommended is trading one setup. And again, the setup is, currency pair, pattern, or whatever the setup, whatever the trade setup is. Win percentage, risk reward, risk percentage. That's one setup, and for that, the specific times that you tested it for. It could be, everything else could be similar, right? Same currency pair, but the times are different, or same currency pair and the, or different currency pair and the setup is the same, whatever it might be. If the parameters are different, then it's a different setup. stop loss, take profit, risk percentage, all that, right? It could be the same pattern, it could be the same trade, but different parameters for stop loss, take profit, different currency pair, whatever it may be. All those are individual setups, right? So until you've reached a 5% increase in your account, okay, for that first setup, and have taken at least 20 trades on that setup, then add an additional setup. Rinse and repeat the aforementioned steps. So that means that when you add that additional setup, you've already reached 5% increase on your account. So that second setup, right, you're above 5%, you're at 5% or better. So 5% of a $10,000 account would be $500, right? So now you have $10,500 in that account. Now from that point, 10.5, right? 5% increase and 20 trades. Because then we know that the 5% increase is not coming solely from the first trade, but it's also coming as a result of the second trade. So if you're at 20 trades and you're not at 5% from 10,500, which would be, 11,050. If you're not at 20 trades, then you keep going until you hit 20 trades and you're at 11,050 or better. Or if you're at 20 trades and you're not at 11,050, then you keep on going, and as soon as you hit 11,050, then whatever else you've backtested, you can add to that, and then whatever that balance is at that point, in order to add another setup, you want to be 5% greater than that, and at least 20 trades on that new trade. Okay? So that's what we recommend, because it gives you a nice cushion, nice buffer. It doesn't mess with the psychological facets, because now you're just trading on your profit, your increase from capital, right? It's not house money. It's your money, right? So never look at it like, oh, I'm just like, you go to a casino and you win, and you're like, well, I'm going to take what I came with, I'm going to put it in my pocket, and then I'm going to take my winnings and I'm going to gamble on my winnings. And you call that house money. Well, this is house money anyway, right? My winnings is just house money, which means you intend to give that back, because it's not yours, it's house money, right? No, it is yours. Same here. When you increase that 5%, that's not house money. That's your money, right? And you intend to keep it. So do things right so that you keep that profit and you continue to grow your account up and to the right. Now again, 2 trades may be just fine. We just use that example because it's a simple example. It may be just fine. The other thing you want to consider though is you don't know where you're jumping into the sequence, right? So let's say this is an actual sequence of winners and losers. Here's the backtest data. Let's go, where do I have that one? So this is how many trades in this backtesting. About 460 examples. So zeros are losers, ones are winners, right? So we can see that, we have winner, loser, winner, 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 loser. But let's go down to where we had streaks of losers. So let's go here real quick. Let's make this simple. And sort. Okay, so these are all losers. And okay. Okay. So we've got all of these are now back in their order. So we can see those are pretty well spread out. That's fine, right? We have nice streaks of winners, some losers sprinkled in between there. Right here we have 3 back-to-back losers. and then 2 winners, and then 3 back-to-back losers. A winner and then a loser. So if we had just back-tested that setup and we jumped in and this is where we started, that would be rough, right? Because we'd hit 3 back-to-back losers right there. And then we'd have a winner, and we'd have a winner, and then 3 back-to-back losers. That in and of itself is disheartening, right? So that's, what is that, 8? So that's 10 trades right there. And out of those 10 trades, we've got 7 out of 10 that are losers, right? If we started right here, let's go 10, 20. So right there we've got 20. And within that 20, we can still see we've got 7, 8, 9, 10. So that's like 50%, right? Even after 20, okay? So that's rough, yes. But what do we say? 20 or 5% increase. Obviously, if we kept on with this, well, and I guess that just depends on what risk to reward we'd be using. But just as an example, or risk percentage we'd be using, because even with a 50%, you could have a risk to reward and a risk percentage that would be profitable, obviously. But you want to give yourself 20 and make sure that you have a 5% increase on your account before adding an additional trade setup. Because you don't know where you're going to step in. You could also step in something like this, right? Like we talked about. Because we looked at the first 20 trades here. That's much more conducive, right? Right here. If we had started at that with our live account at that trade, well, we have 20 trades there and 1 loser. That's not representative of our overall either, right? Because that's like 95% win rate when we know, okay, this is actually, whatever it may have been, 70% win rate or whatever, right? So we know that's not going to be accurate either. Now, it's great because now we've got 20 trades and we'd be, above our 5%. So great, we can add another one because we have that buffer now, knowing that we're not going to continue to trade it at 95%. But that's okay because, we did step in at a good time. We've got that buffer. We can bring in that other trade. We know what to expect. And we're not having to deal with psychological facets of getting drawn down aggressively, before we have an opportunity for these to start working themselves out. All right, guys. So let's see. Yeah, I think we covered everything. Good. All right. Quick reminder, our Trader Lite program is free right now. And you can get set up with that by clicking on the link in the description. It's tradingjobnow.com/KTG. And that will give you free Trader Lite. And once you sign up for that, we'll be reaching out to you to set up your onboarding so we can get the indicators set up on your computer, show you how to use them, get you signed up for webinars where we trade with our members, educational webinars that you'll have access to, set you up with your one-on-one coaching sessions with a professional day trading coach, and you'll get 2 of those. You'll obviously get the real-time alerts, trader chat for mobile and desktop, which you'll be able to chat with other members, other coaches, other traders. So awesome stuff. Obviously, we don't want you to trade with real money with our program. If you're trading real money, that's fine. Using something else, that's fine. But with our program, with our indicators, we don't want you trading real money until after you move on to the next step. And the next step is our coaching programs, our official coaching programs, which all include a minimum of 6 weeks of one-on-one coaching, all include a guaranteed funded account after completion of that 6-week one-on-one sessions. You will get a funded account, and you'll keep the lion's share of the profit that you make with our money in the market. So we want to make sure that we bring in the right type of person to our organization, which is why we do the Trader Lite trial first, because we want you to be able to see that this is a good fit for you. It's something you can do. It's valuable. It meets personal need. We want to be able to see that you're a good student. You show up to appointments, and you at least attempt to do the homework, or you're good at communicating if you're going to miss an appointment, right? So that's all we're really looking for, because we know if we have those things, we have good students, and they show up, then we can teach them how to trade better than most of the industry, and that's not an exaggeration. I'm sure you guys have if you've watched any of those first videos that we have on YouTube, day trading for beginners, we talk about the statistics, right, of having 95+% of individuals that attempt to day trade fail, right? The ones that succeed takes 5 to 7 years to even get it right, and among those, their highest win percentage is 55%, right? 50 to 55%. We're blowing that out of the water, guys. All those statistics we're blowing out of the water, which is why we've just been blowing up as an organization over the last decade that we've been doing this, because we do things correctly. We do it right. We don't cut corners. So I definitely encourage you guys to watch some more of those videos. Do your research, right? Look up the stuff that we talk about. I don't expect for you to take my word for it. I expect that you'll look it up, and you'll see that what I'm saying is true. And what's worse is that most of the organization, most of the industry, you go to YouTube, you go to places like that. Now, we're on YouTube as well, but you're going to be hard-pressed to find the information that we're giving, because most people want to focus on, you can get a bunch of pips, or you can have a high win percentage, which, again, if you've watched any of those videos that we showed in the beginning, you're going to find that that's not how you make profit. That's part of it, but it's not all of it. Matter of fact, you can take the 5 pips, 5 pip trades that we had discussed today and make more than someone would make in a 50 or 100 pip trade, right? It's all about risk to reward, risk percentage. There's a lot of things that go into it that people aren't teaching. They just want to wow you with stuff so that because you don't know any different, you may not know any different, and get you to purchase whatever their program or whatever it is that they're selling, and only to find out that it's not going to work, right? But at least watching these free videos that I have on YouTube, by the way, definitely go there, watch those videos, is going to prepare you for the snakes in the grass. You're going to know the questions to ask. You're going to know what to look out for when evaluating a day trading program. And all that's going to do is push you right back to us, which is why we do it. We want to tell you guys about everything to look out for and to be able to evaluate for yourself if those are the things you should even be looking for. And you'll find really quickly that they are, which is why we tell them to you. And you'll see that most of what's out there is garbage. That's not my opinion. It's a fact. And anyone that does business right in this industry would agree. All right, guys. That's what I've got for you, so definitely click the link in the description. Register for free for our 30-day Trader Lite trial. Someone will reach out to you to schedule your onboarding and your coaching sessions, get all the software set up, everything set up for you, get you registered for webinars, and you'll be on your way. So between now and next Friday, happy trading, and we look forward to talking with you.